Joining me right now is Oxbow Advisors Managing Partner, Ted Oakley. Ted, a lot to discuss with you this morning, and layer onto all of that the president's budget, and his proposals are calling for much higher taxes, both capital gains taxes, corporate taxes, individual taxes at the highest level. How does that play into the story? And I want to get your take about the Silicon Valley meltdown. The bank, Silicon Valley, taking all major banks down yesterday. How do you see it?
Well, I would say, first of all, on his projection or what he wants to do, I can't see that ever happening. I mean, there's just too much in that to be damaging. So I think that won't take. But on Silicon Valley, I think the reason the banks came off, Maria, is that most banks have they have treasury bonds, have certain things. They don't have to mark those to the market. If they had to mark those to the market, their capital structures would really be damaged. And so I don't see that happening. I think what happened out there, a lot of the things they had on the books evidently weren't, treasury bonds. They were something else. I haven't looked at the details, but that was the scare that banks might have to mark to market. I don't think that's going to happen personally, but I just think that'd be too devastating.
Well, look at the value lost yesterday from the big banks. The technology lender Silicon Valley Bank Financial fell at its worst 60% on news that the company completed a sale of its $21 billion bond portfolio. The stock is down again this morning in the pre-market. It's down another 41%. The four biggest banks lost $52 billion in market value yesterday, Ted. You look at something like this and you start saying, well, do we have a real estate problem somewhere that is going to be the straw that broke the camel's back? Is there contagion here as we see all these Silicon Valley companies cutting jobs, their clients? Or do you think the Silicon Valley bank situation can be contained?
Well, Maria, I think you're on to something on the real estate. I don't know the particulars of Silicon Valley. I just know I understand the markdowns. But the thing about most banks, and I'm involved in a bank myself on the side, is that they own a lot of real estate. If you look at their biggest loans, they're in real estate. And, real estate's a lagging indicator. It comes in late. And so you've got a point that they could be looking ahead and saying, hey, we may have more trouble than we think we have. And I think that's part of what people see out there.
Well, that's the other thing. The questions are raging in terms of who's got exposure to all of this, and whether or not that's going to create some kind of a contagion situation. Meanwhile, the Fed is still at it, Ted. It's been almost a year to the day that the Fed started raising interest rates. March 17th last year was the first rate hike in the string of rate hikes. Now, futures are pricing in a 63% chance for a 50 basis point hike at this upcoming meeting later this month. End of March, Ted. What about these rate hikes? Do you think there's a 1-year lag in terms of the impact of rate hikes? And if that's the case, we may not have even felt the worst impact of these higher rates. I know we've seen the impact in housing, but have we seen that, broadly speaking, in the economy yet?
Maria, I don't think so, because what happens, I think you're right on there, because what happens on the corporations, and that's what we're looking for, is an earnings recession. Last year was a problem with interest rates. I think this year will eventually be a problem with the earnings recession, and this high interest rate situation floats into everything. Refinancing, anything we want to look at, and let's just say they go a half. The next time, that means you have an 8.25% prime rate. That means you're borrowing at prime plus 1, you're paying 9.25, and most businesses are going to back away on that.
Yeah, for sure. Ted, real quick, are you raising cash? How are you allocating capital in the face of all of this?
Well, Maria, I always say we're value timers, not market timers. So if we get a value in something, we buy it no matter what. And we have bought a few things lately, but we're about 60% plus liquid, mostly very, very short-term treasuries. So we think if you get paid 5%, why not wait and see what happens?
Yeah, exactly. 5% isn't bad in this environment, that's for sure. Ted, it's good to see you. Thanks so much. Ted Oakley joining us this morning. We'll keep following all of that, Ted.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.